Hi, I'm Shannon Rollins of Shannon Rollins Real Estate, and today I want to talk about a way buyers are getting around the higher interest rates that are being offered in today's market to secure a lower interest rate. VA assumable loans are the buzz right now. Buyers are inquiring to sellers to say, do you have a VA loan? What is the amount of the loan still remaining on it? And what is the interest rate that you have, and is it assumable? You do not have to be a veteran, a military service person, or a spouse of a veteran to be able to qualify to assume a VA mortgage. There are several advantages and disadvantages, so let's talk about the advantages of doing this first. If you are the buyer and you found somebody that had secured a home with a VA loan themselves a few years ago, and say their interest rate is 5% on that loan. Today's rates are 6.5% for VA loans. So there's a big savings for you if you can get a 5% versus 6.5%. That's an advantage for the buyer. For the seller, an advantage is that you're able to advertise and offer something available on your home with a lower interest rate for the assumable part of the loan, where maybe other owners don't have assumable loans. So that makes your house stand out in the marketplace. So it's an advantage for the seller too. Plus, the closing costs can be less for both a buyer and seller in assuming a loan. There is also no appraisal that's required. Here's the disadvantages. If you are the buyer, you want to buy the house where they have an assumable loan and they bought the house 2 years ago. Well, probably the value of the house has gone up over the last 2 years. So you are going to be able to assume a loan just on this portion of the value of the house, but not the current contract price and the difference. Well, lenders don't want to do second mortgages on homes. They don't want to be a backup to a primary lender, because if you default on it, who gets the house? The primary lender or the secondary lender? So lenders don't want to do secondary mortgages. So that means that the buyer has to bring the difference in cash between the amount of loan you're assuming and the current purchase price. Now, a lot of people do 100% VA financing because it's 100%. That's the advantage of it. But if you're a first-time home buyer, that is probably the case. If you're not a first-time home buyer, it is likely that you're moving up and now you have some money to put down towards the house anyway. So you might have the ability to pay the difference between the amount of loan you're assuming and the contract price in cash at closing, so you can assume this lower interest rate. There are other things that you might want to consider as well. A disadvantage could be if you don't get release of liability on that loan from the lender. You need to sign something specific with the lender that releases you from liability of that primary loan. Another disadvantage is that it takes on average 60 days to get the loan to go through when you're assuming the loan. So timing wise, you're going to have to be a little bit more flexible to work with that, and that may not work for you on what you are wanting to buy if you are the seller. So take all those things into account. It is an option out there. It might be a great one. Could be a win-win for everybody. If you want more information about how to do a VA assumable loan, give me a call. I'd be glad to help you. My team and I are on standby 7 days a week, 9 a.m. to 8 p.m., ready to help you take the smoother road to sold.